The cup and handle is one of the most reliable continuation patterns in swing trading, but the cup is the easy part to spot. The real edge is in the handle and in waiting for the breakout instead of jumping in early. Here's the anatomy, the trigger, and the mistake that turns a great base into a loss. 3 parts. First, the cup, a rounded U-shaped base, and the U matters, not a sharp V. A rounded bottom shows selling slowly drying up and buyers gradually returning. A healthy transfer of ownership from weak hands to strong. A sharp V is panic, not a base. Then the handle, a small, shallow pullback near the top of the cup, drifting down on light volume as the last impatient holders sell into the rim. And the rim itself, the high on both sides of the cup, is your resistance. The pattern is not the cup, it's the breakout above that rim, out of the handle. The longer the cup took to form, the more significant the eventual breakout tends to be. The handle is what separates a real setup from a trap. You want it shallow, drifting down in the upper third of the cup, never collapsing back to the lows and on declining volume. A deep, heavy handle means sellers are still in control and the base isn't ready. A tight, quiet handle is the coil before the breakout. The trade is clean and the math is what makes it special. You enter on the breakout above the rim, ideally with volume expanding to confirm real demand. Your stop goes just below the handle low. A drop back under it means the handle has failed and the base isn't ready. Your target is a measured move. Take the depth of the cup from the rim down to the bottom and project that same distance up from the breakout. Now look at the risk reward. Your risk is just the shallow handle, while your reward is the entire depth of the cup. That asymmetry, small risk, large measured target, is exactly why patient traders wait weeks for a clean cup and handle instead of chasing random breakouts. The mistake, buying inside the cup or the handle, anticipating the breakout. That's guessing. Plenty of cups never break out and just roll over. The pattern only pays when price clears the rim on the close. Patience, there is the entire edge. On a real chart, look for a rounded base pressing up under a clear resistance level with a quiet little pullback just below it. The real ones are rarely as symmetrical as the textbook. The cup can be lopsided. The handle can take a few different shapes, so don't force it. What you're really validating is the story, a long, patient base where sellers got exhausted, a controlled pause that shakes out the impatient, and then a decisive close through resistance on rising volume. When that logic lines up on real price, the messy-looking chart is just as tradable as the perfect one. Where it fits, the cup and handle is a trigger built on a long structural base. Stack it with an uptrend, the rim as your key level, and momentum confirming on the break, and you've lined up the whole method. A breakout with all 4 signals behind it is the kind worth taking. So a rounded cup, a shallow low-volume handle, and you enter only on the breakout above the rim. Stop below the handle, target the cup depth. Don't buy the base, trade the break. Subscribe for the full method and trade your own plan. This is education, not financial advice.